Hello friends, you wanted, I got it. I promised you I would come up with an updated video on bullion, on gold. You wanted exact levels, you wanted what price to average down to if you bought at higher levels, and if you've missed the boat, where to buy afresh. Well, here goes, and it's rather detailed. So I've split this video as usual into chapters, and you can watch each chapter at leisure. And please do share this video with smart traders like yourselves so I can spread the cult of knowledge-based investments and trades. Here goes. So now you've seen my earlier video of why I'm bullish on bullion and especially gold, not to mention silver, which comes a little more volatile but still a favorite. My second video was where to buy bullion at honest to God prices and the purest form, and where you can save some money. The third video was why a fall in bullion is actually a welcome thing, because A, if you've bought it, it's a good time to average, even though it might be at higher levels than when you earlier bought it. And B, if you missed the boat, it's a good time to catch the bus before it leaves the terminus. So now we are going to get into specifics. In my recent video on cost of funds, as also the video that I made immediately after the Trump presidency was announced, I told you that there is a possibility that President Trump would try and boost the use of cryptocurrencies. He mentioned the word Bitcoin, but hey, it could be CBDCs. CBDCs are central bank digital currencies. Now, in my video on cost of funds, please do watch that. I've mentioned why I believe CBDCs are inflationary. Without getting into too much detail and lengthening the long format video, the present one, I request you to watch the previous one. So, if at all CBDCs are coming in, buy gold now. The other aspect that worries me is the level of global debt. The US, for example, will be paying $1 trillion. That's right, $1 trillion per annum next year onwards just to service their sovereign debt. What do I mean by servicing their sovereign debt? It means paying interest on those loans. Now, you can say all you want that, hey, central bankers are done with printing currency. They cannot print any more currency to keep kicking the can down the road and hiding all that dust under the carpet. But show me what else do they have as recourse. If at all they are borrowing money from the bond market, like I said in the cost of fund videos, they have to offer higher rates of interest. What does that mean? That means higher deficits. What does that mean? That means debauching or devaluing the paper currency or the fiat currency. What does that mean? Bullish gold, bullish silver. All right. So I am still of the opinion that gold and silver are still a buy. Now, cost of funds going higher will push up inflation because manufacturing costs of everything will go up. Do me a favor. If you haven't been out to a restaurant, go out there and order a meal. See whether your bill, your check, is higher or lower compared to 6 or 12 months ago. If your check is the same, let me know whether the quantity of food that you're served is still the same. Now, Hindustan Unilever recently announced a 5% hike across all popular brands of their FMCG products. What is more is they reduce the grammage. What is grammage? Now the number of grams per serving is reduced. Now hiking prices is called inflation. Reducing the serving size is called shrinkflation. You're shrinking the quantity. Now restaurants are good at keeping the rack rates or menu prices constant, but they resort to shrinkflation. Where earlier one dish was enough for 2 people to eat and come out satisfied, I assure you, many restaurants, They would tell you that each serving is for 2 people, but you will come out feeling a little wanting for more food. Happens to me all the time. Let me come out and tell you some of the bizarre stuff that I keep hearing. One of the most amazing things that I heard in recent times, I hear a lot of the amazing stuff. One of the most amazing things I heard was the dollar milkshake theory. Milkshake, dollars inside, we're going to suck out all the excess dollars from the global markets and therefore curb inflation. Bizarre as it may sound, you can actually Google search it and you'll find many people striving to stay relevant in today's markets by propagating these kind of theories. What it basically means is that inflation is up because cost of money is down because of interest rate cuts, and world over central bankers have printed unbacked currency, which I talked about in my video on cost of funds. Central bankers will withdraw this money and asset prices will cool down, inflation will come down, all will be happy and gay, and all your troubles will go away. But wait, there's a problem. If at all the US was to resort to the dollar milkshake theory by sucking out the liquidity from a straw, you know what happens? The dollar, which is already losing market share as a global reserve currency, will open the door wide for the Chinese yuan. The Chinese will come out and say, look, the US is holding you at ransom by pumping liquidity when it wants and withdrawing liquidity when it feels like. This is erratic behavior, and we are coming here and offering you the renminbi, which will not be withdrawn as per our convenience. Use it all you want. That is something the US Fed cannot afford. The euro is, as it is competing, so is the Japanese yen, so is the Swiss franc to a very small extent. Do you think the US Fed can come out with the dollar milkshake theory? I'd love to listen to you in the comments segment. So humor me. And I'm not just being unkind or cryptic or being a crabbity old man. It's just that time has not been on the side of these kind of bizarre ideas. I've heard pretty amazing stuff like super cycles in natural gas and crude oil going all the way up to $200, $250, $300 a barrel. Natural gas going to $20, $25 per MMBTU. Copper going to 1,200, 1,500 rupees a kilo on the MCX. So the weight of evidence is not really in the favor of a non-participating expert out here. Now, I come to specifics, the data. Take a look at the monthly chart of gold on your screen. What you are seeing is that price consolidated after August 2020 when gold hit a high and then finally broke out in February 2024 to make newer highs. Which means gold prices consolidated for 3.5 years when the stronger hands accumulated the supply of gold which was being offered by weaker hands, and then quietly driving the prices higher after the breakout was done. Here is my drill. Remember what I told you. I'm sensitive to the concept of cost of funds and the time value of the cost of funds. Now here is a smart guy absorbing all that the weaker hands are offering from August 2020. He's buying all the way down and then holding that for 3.5 years. There is an interest cost attached to it. And finally, when the breakout does occur, it gives him a profit, but adjust for at least 6% interest per annum. You would tell me, hey Vijay, in the US it's possible because the interest rates and the T-bill yields etc. are telling me that 3.5-4% is maxed out. Sure enough. But in my video on cost of funds, I told you that these are headline interest rate numbers. The actual cost of funds will invariably be higher. You and me are, I assume like me, you're coming from a business owner family. So you know the headline number and the actual prevalent market number will always be in divergent areas as compared to theorists. So I would calculate 6% as more realistic in the US context. In the Indian context, definitely a whole lot higher. Now, if you've studied somebody called Richard Arms, this guy was a very, very smart and brilliant technical analyst of the 1960s, 70s, and 80s. He came out with a study of how much the price consolidates, goes through a sideways movement, how to calculate how much is the average acquisition cost of the smart money that has accumulated stuff at lower levels. So my ballpark figure is coming to close to $2,000 per ounce on gold in the US market. Add 6% interest per annum, and you see you get an interest factor of $120 per annum. Let's say that the congestion didn't occur in 3.5 years. Take a round number of 3 years. 3 years would come to $360. All right, at the rate of $120 per annum. Now, close to 2000 is something that the average acquisition price of the smart money is. You add $360 to your cost of funds. Now you have $2,360 as the price at which smart money will come out and defend gold. If you were to do a basic back of the envelope calculation of VPR or volume profile, you'll see that the point of control is coming close to 2,325 odd. I'm saying 2,360, volume profile is saying 2,325. I'm not going to grudge you $25 for God's sake. Come on, right? We are looking at the bigger picture here. So can gold come down to 2,300 odd dollars, give or take $50 or $100 here and there? It might. I don't know. I don't have a crystal ball. But will I buy out there if the price comes? I'll tell you what I'm going to do. Give it to me, baby. I'll buy with my eyes shut. What if it goes down lower? I'll buy some more. That's all I can tell you. So, looking at the cost of fund theory, looking at the possibility of cryptocurrencies coming in, which will be inflationary, looking at the global debt, looking at the debauchement of the fiat currencies, looking at the bizarre as it may seem, the dollar milkshake theory, I think the dice is loaded in favor of gold and silver bulls. Would I buy? Yes, I would go out and buy. I'm bullish. Whether it's going to be a good advice or bad, the next 18 months will tell. I'm not running away anyway. Feel free to give me a shout. Will I update my views? Yes, I will. I'm here since a long time and I intend to stay here. I will update this as and when time demands. Now that we've established that gold is a buy, the direction is clear to us. Do we have any kind of a guesstimate as to how much it can potentially rise? And I'm using the word guesstimate because in my humble opinion, nobody can authoritatively state that this is where a traded security will go and that's exactly where it does. So we all conjecture up to a point. Now, let's establish the target based on the cost of fund theory itself, because as a realistic deployer of capital and as a doer of deeds and a check writer, I can tell you with a certain degree of certainty that we guys are basically predominantly concerned with yields. I put so much money here in this trade. This is what the return was and it came in this particular time frame. So my yield per annum is XYZ on the time and price continuum. If I leave out the element of time or I leave out the element of price targets, I've basically given you no data at all, which is why both time and price targets must be mentioned. So what we've established using Richard Arms theory as well as the volume profile theory is that the approximate price of acquisition by a strong-handed bull over the last 36 months is approximately between $1,935 to $2,000 per troy ounce of gold. Now, I've also told you, now realistically speaking, I would calculate the cost of funds at 6% per annum, even though the US bond yields may not be 6%. Hey, like I told you in my video on the cost of fund theory, the headline rate and the rate at which realistically money is available to you may be different. So, just for realistic assessment of cost of funds, say 6% is your interest cost or cost of funds. You've waited for 36 months now at the acquisition rate of $2,000 per troy ounce. You are paying $120 per annum as cost of funds. So you would have paid $360 for 3 years, $60 more for another half a year. So between $360 to $420 per troy ounce is your cost of money. Add to that the base value of 2000 rupees acquisition cost as we stand today. Your cost of acquisition cost of gold is approximately 2,425 odd dollars per troy ounce. That's today. Now, I said whether I will be right or wrong will be known in the next year and a half. So, we project the cost of funds at the rate of 6% per annum for 1 year downwards and 1.5 years out. So, after a year, you add another $120, which would make it $540, $550 more. And after 18 months, you add another $60, which would make it $600. So 1.5 years down the line, your acquisition cost of gold would be $2,600 per troy ounce. That is precisely where gold is trading at approximately currently. If at all a deployer of capital and a check writer is to get his pound of flesh, let's say he recovers 6% cost of capital plus 6% more as additional gratification. Do remember, we are talking about an elephant in the room called gold. Gold, commodities, heavy weighted large cap stocks, unlike small caps, mid caps, and micro caps, do not double, triple, or multiply in price. That's only for those very, very tiny stocks which have barely any floating stock, which can go all over the place. But the big boys give you a lot more steadier and more measured return. Do remember, this is where big money parks huge amounts of money to garner absolute amount of alpha or trading profits. So if at all you were to receive 6% cost of funds for 5 years and an equal amount in profit for gratification of the risk taken, I'm looking at gold anything between $3,200 per troy ounce to $3,500 per troy ounce at the end, or say late 2026. Which means that a 25 to 30% appreciation in the price of gold from present levels in the next 18 to 24 months may be likely. Does it mean that gold will come either to a kissing distance or actually reach the magic mark of rupees 100,000 per 10 grams on the multi-commodity exchange in India? I think there is a fighting chance for bulls to take it there. Just a caveat. In the year 2021 as well as in the year 2022, I had given extremely bullish targets of gold and silver. Admittedly, they missed by a narrow margin, but the fact remains that they missed. Can I miss it again? In all possibility, yes. Nobody has any absolute magic wand. But as a doer of deeds, it is my job to take a stand and to execute on a line of thought. Will I buy? Like I said earlier, yes, I will buy, and I will bet that the price will go up. So buying on declines is the way to go forward as far as I am concerned. Yes, I will update this view as and when required. I thank you for your patience in being with me in this video. Before I sign off, a reminder to subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put up out here. And in the comment segment, do let me know how my videos are helping you become a better trader. And a reminder, please do share my videos if you find them useful enough with all your friends, family, and social media groups. Till we meet again in my next, this is Vijay Bhambwani signing off for now. Have a very, very profitable trade ahead. Take care. Bye-bye.